guys, good evening and welcome to Editor's Roundtable. It was a week of turmoil in the financial space. The Sensex and the Nifty end down with a cut of 2%. Will we see a recovery next week? Thank you for joining in to Editor's Roundtable. I am Reema Tendulkar. Joining me is Prashant, Nimesh and Mangalam. Hi guys, I think we can all heave a sigh of relief. Right?
That the week is over.
The news flow
But the weekend is ahead of us. And if last weekend is any indication, this one could be action-packed as well. Although, I mean, we don't report on it at least, right? Yeah. Not on Saturday or Sunday.
But these guys have some exciting plans.
Cricket, I believe.
Cricket. Watch the match there. So after this show, I just want to rush to the match.
Yeah, so same here. I'll hitch a ride with you. Because there's no parking outside.
And I was lucky to watch the match last week as well.
Yeah, absolutely, Reema. But what a week we've had, right? Eventful and I would say historic, right? Actually, let me just go across to the big wall and tell our viewers what the week was all about. Because this is, you don't see weeks like this very often. And we did see one. At the start of the week, this was being compared to Lehman, Bear Stearns, 2007, 2008. Thankfully, it turned out to be nothing like any of those episodes. But I have to say that history was written tick for tick. Let me tell you why. And the story starts last Wednesday. That is when the Silvergate Bank announced that it is shutting down. I mean, actually, that announcement came after US markets shut on 8th of March, which is last Wednesday. Let's move on. The story moves forward. I mean, the turmoil started. The market started to worry a little bit, but not full-blown. And then you had the Silicon Valley Bank, which failed. It went into FIDC receivership. That was Friday. Things started to accelerate post that. Move on to the weekend. That is last Sunday. You had the failure of Signature Bank, which went down. These are regional banks as we've been discussing quite a bit. Markets were panicky. We woke up the next morning, Monday morning here, with news, good news, that the US has stepped in to protect depositors. Also, as a consequence of this, all of this financial turmoil which was emerging and uncertainty which was there, Fed hikes were priced out of the system. They completely vanished. From 50 basis points 4 days earlier, we started the week with 0 rate hike expectations. Tuesday, we got core CPI numbers which came in, which were stronger than what was expected. Some of the Fed rate hike expectations were priced back in. Wednesday, the worry was passed on from US to Europe. Credit Suisse was suddenly the epicenter of all the panic. European markets started selling off in a big way. Thursday, you had Credit Suisse, which took $50 billion from the Swiss National Bank. And the ECB, later that evening, hiked interest rates by 50 basis points as well. And this morning, we woke up with news, that is Friday, that the US bank consortium has put in $30 billion in deposits into FRC. This is a timeline, a tick-by-tick timeline in terms of what has happened over the last 1 week or so, a little over the last 1 week. But these are just the highlights, right? I mean, we lived through what went on, the ups and downs, and boy, it was up and down many times over. Now, how has the crisis affected markets? This is interesting. Again, this is price change since the 8th of March close, last Wednesday close. And it's stunning. The S&P is down under 1% for all the troubles, under 1% lower. The Nasdaq is up 1%. The Nifty is down 4.2% with all the distance. The Nifty is the one which actually is taken it on the chin. The US 2-year yield is down 92 basis points. It was above 5% a week before, a week and a half back. It's now a little over 4%. The dollar index is down 1%, and oil prices have sold off very aggressively by about 10% or so. Now, I just kind of dug in a little bit more in terms of Nifty is down 4.5%, right? And US is up. But how does Nifty compare to other Asian emerging markets? Guess what? Nifty and Sensex are the worst performing emerging markets in this current risk-off episode. So, I mean, actually the only market, forget sort of emerging or developed, the only Asian markets which has done poorly as compared to Nifty is Japan. That's it. Otherwise, we are the worst off. And, perhaps some of the reason is the FII selling, right? But there have been so many blocks, so to kind of cancel the noise out, what I did is basically take total DII and FII inflow into the market year to date and subtracted the total amount of blocks which have happened. So the total institutional inflow into secondary markets this year stands at 7,200 crores. That's paltry. That's very, very small. Valuations have come off quite a bit. The Nifty one-year forward PE now, as of the end of Friday's trade, stands at 17.3 times. The average for the last 15 years is 17 times. But when you look at PE multiples, the discount rate matters quite a bit, and that goes back to talking about interest rates. Direction of interest rates are extremely important, and that will determine, what happens to interest rates and hence valuations, etc. And to that, in that context, we've got the FOMC, which will be meeting next week. So just thought, I'll put some of this stuff out. With the amount of volatility we've had, I have to say that markets are a little volatile. Markets are a little jittery and shaky as well. And I think it'll take some time before some normalcy, some stability kind of returns. Nimish, you've been talking to a lot of dealing rooms as well. What are you hearing?
Prashant, you put out some interesting data. The fact that Nifty was down 4% this week despite global markets, well, there was too much of noise, but they were stable. And that means that, a lot of crucial technical support levels got broken on the Nifty. And that actually led to a lot of fear as well. So the mood is very, very downbeat. There is extreme pessimism, so to speak, when you talk to the dealers or the larger investors or for that matter traders as well. So the level to watch now is 16,800 on the downside. If you look at this week, twice we came to those levels and we rebound from there. So that's a big support level to watch as far as the Nifty is concerned, at least in the very near term. So that's something to watch out for. Last week, if you remember, I had suggested that the block deals will continue and we're going to hit $5 billion before the month of March end. In fact, it happened this week itself, right? Another $1 billion block deals happened and we've touched over $5 billion as far as the supply is concerned. So that supply, my sense is likely to continue. But the big feedback now is that while everybody is watching about block deals, my sense is there could be large M&A transaction as well. That's the feedback from investment bankers, that watch out for some large deals which might happen before the end of this financial closure. So that will be important to track, and that can have an impact on some stocks as well. I guess from a trigger point of view, the Fed meet next week. That's going to be very important. I guess Street is priced in the 25 basis point rate hike. So if that comes, I guess there will be a bit of a relief rally, so to speak. That's the overall feedback from the dealing room. So that's something to watch out for. The other important thing is, if you look at the mood, at least in the last 2 days, the feedback was some bit of risk appetite is back, largely from the smart HN investors. So around 16,800, 16,900, some money was put to work by some large smart HNIs, and the feedback is they are sensing a bit of a pullback post the Fed meet. So that's something to watch out for. But I guess the supply overhang is something that's a big niggling factor, and that's likely to continue till the March end. That's the overall feedback. But I think most important thing is the banks. That's been a big underperformer, and I think you've worked on some number on the banks as well.
Well, absolutely. This week was all about the banks as people were assessing the health of the global banks in US and Europe. So the big question now, is there a risk for the Indian banks? Right? How do they hold up in light of what we are seeing right now? So first, let's take stock of how the banks performed. This week, the Nifty Bank was down 2.2%. The PSU banking index slipped 4.5%, and individual names, a Bank of Baroda, a State Bank of India, all took a deep tumble. So we're taking a hard look at the health of the Indian banks, and we're evaluating them on 3 key parameters. The first one is the quality of the liabilities, that is your depositors. Secondly, the yield impact on the investment book. Is there a risk of big losses, the M2M losses on the Indian bank's portfolio, on their bond portfolio, due to the rise in the interest rates? And third, the risk to the asset quality. So the first one, let's talk about the bond portfolio of the Indian banks. Now, CLSA says the Indian 10-year bond yields were at 7.5% pre-COVID, early 2019. They dropped to sub 6% during COVID, but now they've rebounded to 7.4%. CLSA's discussions with a few PSU banks suggest that the break-even for an M2M loss for PSU banks is roughly 7.5%. So even if yields go up by another 500 basis points, according to CLSA, the PBT hit is likely to be manageable and at approximately 5 to 7%. So this is on the bond portfolio. Now let's talk about the liabilities. Depositors. Is there a risk of a big outflow of depositors? Something that we've seen in the United States and few of the banks like SVB. Now Jeffrey says that in India, household depositors constitute more than 60% of the depositors. Now, these are sticky. They don't typically move to GSEC. So, the concentration risk in India is very low, and therefore, the risk on this front is on the lower side. And the third parameter to look at is the asset quality. Now, here, what we've picked up is the mortgage rates in India pre-COVID were 8.5%. They fell to 6.5% during COVID, but now they're at levels of 9%. So the increase of EMI rates in India is not as severe as what we've seen in the Western economies. And therefore, the likely hit to asset quality is again likely to be on the lower side. And plus, the bank's asset quality, the kind of buffers, the contingent provisions that they are sitting on is the best that we've seen in over a decade. Banks themselves are not very worried. This week, Morgan Stanley put out a note in the Indian banking system. They met with a lot of financial institutions, and their key takeaways are that banks are saying that the loan growth is likely to remain healthy. Yes, there will be some NIM moderation next year as funding costs catch up, but the asset quality remains benign. So banks are not worried. Are the brokerages worried then? So here's a quick roundup of the brokerage commentary. Jefferies, in its note this week, says the SVB test on the Indian banking sector holds up again. CLSA says negligible contagion risk, no material impact except for heightened risk premiums. And Macquarie says it's Goldilocks with a minor bump. So that's just a quick summary of what is the health of the Indian banks based on what's happened globally. We need to slip into a very short break at this point, but on the other side, we'll talk about the top management changes that have taken place this week, the announcements on that front, and we'll also invite Hiren Ved of Alchemy.